A month or so ago, I released a video talking about the potential impending economic recession. And I talked about how to best prepare for it, especially if you're a beginner investor. Well, now I have to be honest. Although recession is forecasted and likely, there is no guarantee that it will come. But in this video, I'll be talking about the most reliable investing tool, recession or no recession, primarily advocated by none other than Warren Edward Buffett. If you haven't heard of Warren Buffett, search him up. His net worth starts with a B. Now I know every investor, especially the young ones my age in their 20s, are looking to be the next Wolf of Wall Street and find the stock that's going to make them millions. They are envisioning this stock is going to take the world by absolute storm and 5, 10, 20 or even 100x in value. The unfortunate truth is predicting these stocks are very hard, and anyone that got lucky enough to predict that is probably masking that one prediction over hundreds of predictions of stocks that they thought would do similar and end up going absolutely nowhere. Stocks that exponentially increase in value over the coming years will come, I have no doubt about that whatsoever. But I also do know for every stock that 10x's in value, there'll be hundreds if not thousands of stocks that do the complete opposite and lose more than 90% of their value. And the saddest thing is, a loss in a stock's value hurts much more than a gain in the stock value. Let me explain. If you short a stock that goes on to lose 50% of its value, provided you close the trade, you doubled your earnings. Whereas if you long a stock that goes up 50% in value, you've only increased your earnings by 1.5 times your original investment. Do you get what I'm trying to say here? A stock that loses 50% in value needs a 100% gain just to get back to its original position. The stock market does not reward volatile stocks that go up and down quickly. Therefore, instead of dealing with the emotional turmoil of individual stocks, let me invite you to a world of index traded funds and exchange traded funds. It is at this stage of the video where I must openly state that I am not a financial advisor. I am purely here to provide information that I have learned and hopefully breaking it down into layman's terms so even complete beginners can understand what I'm trying to say. What you choose to do with your money is what you are 100% liable for. Okay, so what are index traded funds and exchange traded funds, which I will refer to as ETFs for the rest of this video? Well, remember how I mentioned how volatile individual stocks were earlier? Well, index funds and ETFs are a basket of multiple individual stocks all under one fund that you can trade. In fact, there are over 130,000 mutual funds worldwide. These funds can group stocks depending on what index they come from, their country, their industry, and you can have small, medium, and big cap stocks depending on the size of the company. For my sports lovers out there, think of it as instead of investing in the Los Angeles Lakers, who right now stink, you are investing in the whole NBA. This is absolutely brilliant because although general stocks do fluctuate in value, you're investing in a pool of stocks. So you will not be worried about general stocks going down in value because the whole ETF should track the price of the market, which usually goes up. There are two types of funds, active funds and passive funds. Active funds are, as you guessed, actively managed, meaning you have hedge funds paying people big money to dress up in expensive suits and track the prices of stocks each and every day and decide whether to add it to their fund or remove it from their fund. Some of the biggest hedge funds in the world include Bridgewater Associates, JP Morgan Chase, and BlackRock. These funds are a great option, but like most things in the world, include human judgment. And as we all know, whenever a human has to make a decision, there's always a chance something can go wrong. This is why, and for those of you that remember the title of the video and the thumbnail, you will recognize that I said I prefer passive funds. These are funds that are not actively changed all the time. They are tied to a pre-existing index like the S&P 500, FTSE 100 for example, with specific weighting to particular industries and companies, with blue chip stocks such as Apple and Microsoft having a higher weighting in the fund than T-Mobile for example. Weighting purely means how much the stock or industry is in the fund. Without a doubt, the most famous passive ETFs are provided by Vanguard, Ishares, and Invesco. Take for example the world famous S&P 500 index, which is VUSA for the UK viewers and VU for the USA viewers. The S&P 500 has granted investors an average annualized return of 10.5% since 1957. That is 10.5% on average per year. That is through the Cold War, Vietnam War, dot-com crash, 9/11, housing crisis of 2008, COVID, and many more events. Because the key word here with S&P is reliable. Trust me when I say the word guarantee does not exist in the world of investing, but the S&P 500 is about as close as you are going to get. But without a doubt, the most beautiful thing is the longer you wait after buying the S&P 500, the longer you get to watch your money grow decade after decade after decade. But don't just take my word for it. Warren Buffett said, and I quote, "I recommend the S&P 500 index fund and have for a long time to people. The trick is to keep adding to your S&P investments over time, reinvesting dividends and not cashing out. This means you can benefit from the beautiful art of compound interest." I recently read The Psychology of Money, brilliant book by the way, and in there it had a line about Warren Buffett that I will never ever forget. $81.5 billion of Warren Buffett's $84.5 billion net worth came after his 65th birthday. That tells you all you need to know about compound investing. So in this quick video, you've learned everything you need to know about passive index funds. But now here's the interesting part. If you want to know about the best passive funds that I personally invest in, I'm going to be dropping a video in the very near future about the top 5 passive index funds in my opinion. So make sure you subscribe and stay tuned for that. Or if you're watching this video late enough, click the end screen card at the bottom of the video and that should take you directly to that video. But with that being said, if you're enjoying my content and want to see more financial videos as well as productivity hacks and student life, make sure you like the video and subscribe down below and hit the bell notification so you never miss a video. And if you have any questions, queries or general comments about what was discussed in this video, be sure to leave it in the comment section down below. I'll be happy to respond to any questions as I want to help you guys out. As always, thank you for staying until the end of the video. If you enjoyed and are dying to see more financial tips, productivity hacks and student life videos, this is a place to be, so make sure you subscribe down below and I hope to see you lot in the next video.